Last year, private equity firm Searchlight Capital achieved roughly $4 billion of realizations, the strongest year in its history. Eric Zinterhofer founded the firm in 2010 with a focus on communications, media, and business services across North America and Europe. And now, he says Searchlight is steering away from disruption risks. Eric joins me now for an exclusive look at the big picture when it comes to deals. Welcome to Bloomberg Deals, Eric.
Good to be here. Thanks for having me.
So glad to speak with you.
Thank you.
We saw how the first quarter of 2026 was a banner quarter of deal making. I just want to start with this idea. Is M&A really back?
I don't know that it's fully back in my realm, but I think in the bigger realm, it is. And the reason I differentiate between the two is when you look at these large cap, big companies, growth is challenged in many sectors, and M&A can help drive growth, drive synergies. And so you're seeing a lot of large-scale M&A, which I think we'll continue to see over the next year.
Is there a shift, do you think, away from sponsors and towards strategic buyers?
We've seen that. Certainly, you mentioned we had $4 billion of realizations over the last 12 months, and that was predominantly to strategics for the reasons I described. In the case of Ziply, Bell bought us, and it was about expansion into North America. It was a growth story. Same with our sale of Euclid, which was about basically CRC expanding into a whole new realm of insurance where Euclid was the global market leader. So I think these were growth-driven acquisitions in both instances.
How much more competitive are processes now than, say, a year ago or 5 years ago?
In terms of the number of potential buyers for assets, for good assets, highly competitive. We're seeing, at least in the stuff that we're participating in, good assets are seeing multiple buyers at high prices, but it's really bifurcated. What you don't see is a whole host of companies that are either not for sale because buyers know, or sellers know that they're probably not viable, or if they do come to market and they're weaker, often failed processes.
So let's talk about the IPO window, the exit environment for PE overall. We know there's a lot of big IPOs due to come out later on this year. Everyone talks about SpaceX, OpenAI, Anthropic. Is demand really as strong as it appears, or is it just concentrated at the very top end for these giant companies?
We're going to find out. I do think that what you said at the end is more likely the case, that a lot of the demand is going to get sopped up by the SpaceXs of the world, but we're going to see, because there are some good companies that are kind of growth at a reasonable value type of companies that are going to be coming public over the next year. And I think it'll be a really interesting thing for you to watch and for Bloomberg to watch to see if those things are going to be successful. I think in some instances they will be, but I am worried about the public market's health and depth for a lot of good companies that are not these super high-profile companies like SpaceX.
Say more about that. What do you mean? What part are you worried about? Is it for the ordinary companies that are just trying to get out?
Yeah, I think the reality is if you're a typical company, let's say you're a $2 to $5 billion market cap business, there's not a ton of liquidity in your stock these days. I mean, you're relying a lot on index funds, quant funds. You don't have a lot of fundamental investors in those companies. You don't have a lot of research coverage. And so, and there's volatility around quarterly results for those companies that can be very difficult to manage through. And so I do think that there are structural challenges in the public market that didn't exist 10 years ago. I mean, if you go back 10 years ago, most of your investors were fundamental investors. You could pick up the phone, you could talk to them, you could tell stories, you had good research coverage. All of that has changed. And it's something, I actually think it's something that business people need to look at more broadly.
That perhaps they're not fully appreciating right now.
Correct.
So this has implications for smaller companies that do want to go public, especially before the SpaceXs of the world do so.
Right.
Are you seeing a rush to market right now before SpaceX lands?
Yeah, in the micro world, the day-to-day world, you're right. You are seeing that where people are like, let's get out before SpaceX. They might take all the air out of the room. There's only so much you can do, to kind of move quickly around those things, but around the edges, that's absolutely happening.
I noticed that you are sitting on the board of Estee Lauder, and that's the beauty giant that's in the middle of a massive turnaround effort and is in active talks to buy Spain's Puig Group. How does a company like Estee Lauder go about doing both at the same time? Because it's challenging enough to execute a big turnaround strategy on your own without the added challenge of integrating another company.
Yeah, I mean, I really shouldn't be commenting on that, given that we're in the middle of all of these things, but I would say broadly, for any company going through this, that's part of the job. And you have to make the right long-term decisions in the face of near-term execution challenges. And I think any well-run company should be able to balance those two things.
So when it comes to underwriting, I'm curious, in your view, what has changed in underwriting now versus a few years ago? Compare and contrast.
Well, we've been really hewing to this disruption theme for a while. So our underwriting hasn't necessarily changed, but the emphasis on that point has accelerated in the face of AI, which is truly transformational. So if you think about what we're doing, we're often investing in companies where there may be second and third order benefits from AI, but the valuations haven't really gone through the roof the way kind of first order AI investments have done. And then there's another category of investments that would be very, almost resilient or almost counter-cyclical to AI. So we just bought a nursing business. Think about the dearth of nurses in the United States. It's massive. So there's already a structural challenge that we're solving. Now think about what's going to happen in the white-collar world with AI. The retraining opportunity for nursing is becoming even larger. So sometimes, that's the way we've been thinking as investors, and we've been thinking that way for a decade. Mm-hmm. That thought process is even more important now.
So where does your recent purchase of a B2B live events company called Closer Still Media fit into what you just laid out?
It's a great example. This is a sector that's really resilient. It's growing nicely. It's going to continue to grow over the next decade. And you know this better than anybody else. Convening people is critical. Every conference in the world that we talk about, the most high-profile ones, whether it's Davos or this Milken conference that just happened, there's a reason why people convene. And if you look at Closer Still, in the categories they're in, they're market-leading critical convening events for the business people in those realms. We don't see that changing.
Overall for this year, do you see yourself doing more buying or selling of assets?
Probably more selling than buying. I think we'll continue the trend from last year. We've been selective in what we've bought. Obviously, Closer Still, you just mentioned, is something we're very excited about. But the bar is very high for us. And we're the type of firm where we can afford to be that way. There's kind of, in the private equity, there's kind of two realms. There's the realm where asset under management growth is the most important metric, and then there's the realm where returns are the most important metric. And for our firm, we live in that latter realm. And if you're in that realm, it's pretty hard to argue that you should be super aggressive in buying right now. I think the argument is you should be selective. But if you have good assets that are available for sale, now's a great time to do it.
So where are you leaning towards? Where are you avoiding?
In terms of sectors?
In terms of sectors.
Yeah, in terms of sectors where we're leaning toward or highly recurring cash flow, I'd say mostly in resilient sectors. What we like a lot in industrial services, for example, are areas where you have second derivative benefits. So we have businesses that really service the electrification of the United States that really had great core demand before AI took off, but we're seeing accelerated demand from it. And that second order benefit is something that we're really interested in. We're investing heavily behind. So we'll continue to look there. And then, obviously businesses in our core sectors in media and telecom like Closer Still are still very much a focus for us as well.
I should mention as well, of course, you know this, Ted Turner dying today at the age of 87. He was the OG media mogul. He founded CNN. He did a bunch of deals that kind of transformed the industry. Is there a new Ted Turner of 2026?
I think it's more about platforms and less about people these days. I mean, you think about the dominant media companies, and it's YouTube, it's Instagram, it's TikTok. These platforms have become where media lives predominantly, and then the rest of the media industry needs to catch up by building scale, which of course you guys are covering extensively, and we've seen a lot of that. Paramount being a great example of that most recently. That trend needs to continue. for even the Disneys of the world to keep up with these big players. So it's less about people. He's a legend. I remember watching the Gulf War on CNN as a college student and just being blown away by 24-hour coverage of this. I think that he should be talked about a lot because he was just a unique individual. I learned a lot about him through John Malone, who I've worked with over the years, and he's an extraordinary person.
Eric, thank you so much for sharing your thoughts. Eric Zinterhofer is founding partner of Searchlight Capital.